Hello everybody, Steve Griffiths, developer of the MT Predictor software program. While I look at the risk disclaimer, could you just let me know whether you can all hear me and see the slide and MT Predictor in the background okay? That'd be great, thanks. Right, just to remind you that all examples in this training room should be considered as hypothetical. No trades are actually taken, they're just shown for illustration and training purposes only. Remind you there's a risk of loss in trading and investing, or put another way, all traders know and accept that losses can and will occur. Right, so welcome to today's training room. Get this out of the way. There we go. Right. So first of all, I'd like to basically just remind you all about the two different sessions we look at with the Eminis. This is only applicable to the US Eminis, which is the NQ we've got here, the ES, and the YM. With the E-minis, there's two different sessions we tend to look at. There's either the 24-hour session, so if I pull another chart up, there's this one here, that's the 24 hours. By the way, this is NinjaTrader, our add-ons for NinjaTrader 8, which I'll be using for the main part in today's today's webinar. I haven't used NinjaTrader for a while, so it's nice to use this. Obviously, the same tools are applicable in our standalone version and in our TradingView scripts as well. So what's the difference? So on a 24-hour session, what do we mean by that? Well, if I go to data series, you see here it says trading hours in the middle. In other words, it's 24/7. So in other words, this is the chart of the E-minis for all the time. In other words, all the time that they're actually open and trading. So what's the difference between what we call the day session? Well, this is the day session. So if I right mouse click, do data series, can you see here it says CME Index Futures Regular Trading Hours, in other words, RTH. So what this does, it basically plots the data between 9:30 and 16:15 New York time. In other words, it's when the US market is open. So why do we do this? Well, we do this because, well, basically in the old days, I'm an old school trader, been doing this for 34 years. In the old days, there wasn't much trading in the E-minis overnight. In other words, during the rest of the trading day, it was mainly done when the US market was open. So that's why most day traders, they tended to just look at what we call the day session, because that's where the most of the volume was. And if I go to the YM here and I, oops, not the YM. If I go to a 24-hour chart, for example, of the YM, can you see the volume here? In other words, that high volume there is when the US market's open. If I scroll back, can you see this is when the US market's closed, in other words, overnight. And again, here's the higher volume during the US market open. So that's why we tend to just look at the data when the US market's open. So the question is which one should you trade? Well, you can trade both. I know people don't like it when I say the choice is up to you, but it is up to you. If you're, apart from if you're using TradingView, because they only have the 24-hour charts, they don't have day session only charts. So we'll be looking at a good example here on the using the 24-hour charts on the YM a bit later in the webinar. So I'll come back to this one a bit later in the webinar, but you really can use both. I mean, in the old days, I tended to just mainly focus on just the day session only, because that's when most of the day traders used to do their trading. But now there's far more people trading electronically and from other parts of the world. So the 24-hour session has a lot more volume overnight and can get some nice trades like this one here during the overnight session. It also depends whereabout in the world you are. If you're in Europe, well, you want to be trading, during the morning in UK time, which obviously is in the overnight session, US time. But if you're in the US, well, then you probably want to focus on just the trading throughout the day. But what does that mean? Well, it means that because the market is we only plot the data between 9:30 and 6:15, you get gaps. So a good example is this, like on the NQ yesterday. Do you see this is the NQ? This is on a 3-minute chart from yesterday. Do you see the market gapped up? And then see there, see that there's a big hole there? That's what's called a gap. So this is what happens with the E-minis on a day session only. You can get what we call gaps. Now, some people say that's well, why on earth would you want to have something that has a gap? Well, there is some tools we can use that can actually make use of that particular gap. Because what does a gap signify? Well, a gap signifies that there's added strength between where the US market closed, or the 1615 close the previous day, compared to where we're opening at 9:30 on the next trading day. And this is for yesterday. In other words, there's been strength overnight. So how can we make use of that? Well, a couple of tools we've got that we don't tend to talk about much because they're not specifically MT Predictor tools that we have in our NinjaTrader 8 add-ons. We also have in our standalone version. If I go to indicators and I scroll on down to our MT Predictor, our MTP indicators, you'll see there's a couple of extra ones in here that we don't talk about much. There's the ATR range, so I'll just double click on that, add that to the chart, and then the MTP opening gap. I'll double click on that, open to the chart, add them to the chart, then add them on. So what do these do? You can see they suddenly add some extra things onto the chart. They add 2 black lines. You can see if I scroll back, there's 2 black lines there above and below where the market closed yesterday. So what are these? What we're doing here is something very simple. Basically, we're working out the average true range over the last 20 days. So we're simply just taking the high from the low in the trading day for the last 20 days and averaging it. In other words, how much the market has moved in the last 20 days. In other words, where it's gone. Have there been big moves? Have there been narrow moves? We then add that to the previous day's close, and we then draw that as a horizontal line. Why do we do that? Well, we do that because that gives you the average movement of the market or of the E-minis. These are only applicable to the E-minis, okay? Just the US E-minis. It's not applicable to any other markets. It's just the E-minis. So it gives you where the market has moved during the day on average over the last 20 days. Again, it's just purely an average. So as you can see here on the NQ yesterday, what happened was the market basically gapped up. In other words, it made a move up above the previous day's high. Now we have a little indicator here that actually shows you this. So here, can you see it says outside gap up? It gives you what the previous day's high was, the previous day's close, and also the previous day's low as well. So if I go back to the day before, whoops, never get the right one here. You see the previous day, it said inside gap. So in other words, the market opened within the previous day's range. In other words, it was below the previous day's high and above the previous day's low. So in other words, it opened within the previous day's range. So what happened yesterday? Well, yesterday it did something different. It made an outside gap. In other words, it opened here. Do you see that? It opened above the previous day's high. So where the market was the previous day, it opened at 9:30 above the previous day's high. Now that shows strength in the market. In other words, there's buying strength coming in because it started trading basically above where the previous day's total range was. So one thing we can do on this is we can build a little trade strategy around this. Again, this is not particularly MT Predictor, but it's some tools we've added in for you. We can add a trade setup in and around the first 3-minute bar. So do you see that first 3-minute bar, which is that bar there? What we can actually do is we can look at that and say, well, we know that the market has made a gap up. Therefore, we think that there might be some strength in the market. We can then look and say, right, where do we think the market's going to go to? That's when we use our ATR range. Remember what the ATR range is? The ATR range is the average range the market has moved in the last 20 days. And we basically add it to the close, the previous day's close, take it from the previous day's close. That's our two black lines. So we know that that is where the market has gone to on average over the last 20 days. So can you see the unique situation we have here? It's made an outside gap up, so indicates strength, but as of the close of that first 3-minute bar, we're nowhere near the high of the average range. In other words, the market has not got to where it has or would have done if it had made the average move over the last 20 days. So what we can do is we can build a trade strategy using our manual risk reward tool here in and around the first 3-minute bar. So what we're going to say is we're going to buy on a break above the first 3-minute bar. Our stop, if filled, is going to be below the low of the first 3-minute bar. And then we're looking for a move of about 2R. We're looking to see whether a 2R potential profit is possible within the next day. In other words, is this 2R level less than where the average true range is? So do you see what we're doing here? We're saying that we're expecting the market to carry on going up, but we don't want it to have got to where the average is over the last 20 days. So if this 2R level here, which is here, is less than the move over the last 20 days, then we can consider a trade. You can either then look to come out at the 2R level, which will be there, or as the market's strong, you can see it's above our ATR level. You can run with your ATR stop and then perhaps get stopped out. You're going to be stopped out about there, wouldn't you? For about, well, it's almost 3R, isn't it? So can we call that 3R? You'd be stopped out at that level there for 3R profit. So do you see how we can make use of a gap in the US Eminis? So remember, we're only looking to do this when you get an outside gap. The previous day, you wouldn't be doing this because you never can move NinjaTrader up and down that well, because the previous day had an inside gap. So we're not looking to do it on inside gaps. We're only looking to do it on outside gaps. And we're also looking for the market to move with us straight away. So as you can see here, it went straight up through the previous day, through the previous bar's high. In other words, the first 3-minute bar's high, but it didn't go back down and take the low out. Look how different that is for the ES. You see what happened on the ES? It had the same thing. We had an outside gap up. We hadn't reached the daily ATR, not by a long way. But if I put the risk reward, the manual risk reward in around the first 3-minute bar, do you see what happened? It went down below what would be the stop level before breaking above the high. So if it does that, we think, well, the market is not as strong as we might have anticipated. Therefore, we cancel our orders and we don't look to take a trade. So can you see what we're trying to do here? Is we don't want this happening. In other words, it going against you before going with you. What we want to have happen is it to go with you straight away before getting to what would be your stop level, and then looking to run at least 2R, as long as that 2R is less than the average true range for the last 30 days. So this was a question by Randolph. So thanks very much, Randolph, for sending that question in, because he says he hasn't seen me use the ATR range for a while. So I thought this was a good example yesterday, as not only to show you how the day session is different compared to the 24-hour session on the US Eminis, but also how you can actually make use of that by looking to use the outside gap on a day where the move has got potentially less than what it's done over the last 20 days. So does that make sense to everyone? And can you see what we're looking to try to do with this particular setup? I mean, I suggest that you back test this yourself. You go through and have a look previous days because these indicators are on the chart here in NinjaTrader. So you can look at them and you can see what it would have done over the last how many days. So you can go through and take a look at it, but back test it and see whether it's a trade setup you like. If you're not particularly worried about taking that particular trade setup, what information can this give you? Well, because it's a gap up, it indicates strength. So what happens on that is very often when you get an outside gap up like this on the E-minis, they will go through any DP levels you have on the higher time frame. So if you're out on the 15-minute chart, if you're out on the 15-minute chart and you placed your DP levels on, it'll probably go through them. So it is a also a tool you can use to help you decide on whether the market is going to go through any DP levels because there's strength coming in on the market as well. So you can use it as a general market gauge as well as a particular trade setup. So there you can go through and have a look at what it's done on previous days there in NinjaTrader as well. So are there any questions on that particular tool? Again, it's not a particular MT predictor tool. Tim, you can't use it on other instruments because it's only applicable to the day session. So it's only been designed for the US E-minis because they have a day session. So that's why it's designed for the US E-minis. So any other questions on those particular tools? So again, it's the MTP ATR range and the MTP gap opening, which are those indicators in NinjaTrader. ATR range and NTP opening gap. So a couple of other tools you can use in NinjaTrader as well if you wish. I hope you found that that helpful. Right. Now I'd like to have a look at a particular trade setup that came in beautifully earlier today on the YM on the 24-hour session. So this is again looking in the 24-hour session, and this sums up basically what I was carrying on from last week. Remember last week I was looking at the psychology of trading because quite a few guys were saying how hard it's been over the last couple of weeks. In other words, there's been very few trade setups. There's been some losing trades. It's been very difficult. Well, this is a good example of how the market goes in cycles. Because remember I said last week that after a period of when there's been very few trades set up, it's been hard, the market tends to go round and we tend to get some very good, nice and clear, clean trade setups. So this is a perfect example of this in action. And it also gives me a chance to review MT Predictor for you guys who are new as well. So this is pure MT Predictor now. So first and foremost, MT Predictor is not a black box system. We talk about this every week, and I want to just reiterate it, is that we don't look to take our MT Predictor's trade setups 100% as if it's a mechanical trading system. The reason we don't do that is because markets are random about half the time, if not slightly more. In other words, the large degree picture is not clear. In other words, you're driving in fog, as I call it. So in other words, you should only be looking to do trade setups when the picture's clear. So of course, the question you all can be asking is, how do you know when the picture's clear? Well, for this, we go to the higher time frame chart. So on a 15-minute chart, the higher time frame would be the 60-minute. If you're using, say, daily stocks, the higher time frame would be the weekly. If you're, say, looking at 4-hourly Forex, the higher time frame would say be either the 8-hour or the daily. You're looking for time frames between 3 and 5 time frames higher. So what do we do? Let's just put a bit of white space on the right-hand side here so we can let's have a look at this. Right. Let's go back in time a bit, like that. What we do is we go back to previous highs and lows. The highs and lows to choose, we've talked about in detail in previous webinars. If you haven't looked at the webinar on that, there's one from a couple of weeks ago, and I suggest you review the recordings that are in the member section of the website, because they go into detail about which pivots to use. But as you should all remember, if the market is going up like it is here, we take the previous high in the same direction. So as it's going up, we take the previous high in the same direction. If we right mouse click here, we do decision point. I'm only going to be looking at the typical because, as the name suggests, that's typically where the markets tend to reverse. For you guys who are a bit more experienced, you can use the maximum, and perhaps we'll have a quick look at an example of that off this low here in a few minutes' time. But we typically only work with the typical. Excuse the pun there. So what are we looking to do with this? Well, we place it on our chart and we ask the question of the market. We're saying, if you get to this level, not that you're going to get to this level. In other words, it's not a projection, it's a question. In other words, if you get to this level, what are you going to do? If you get to this level, are you going to make a reversal? In other words, is the market going to do what you anticipate? If I move forward, can you see how the market did indeed, in this particular example, reverse off that high nicely? So this is when you come down to the shorter time frame and you look to see whether, first of all, any trade setups at that reversal. Noted, I haven't looked at the MTP trend yet, or the market analyzer or scanner. We've basically been asking the question is, what are you going to do, market, at this projected level? If you then get a setup at this level, you then look for the MTP trend to be in agreement with this. In other words, here it was blue for up, black for in the process of making a reversal, and red for down. So here we had a VS sell, a volume spike sell. Again, there are recordings in the member section of the website that goes through in detail exactly what this kind of trade setup is. But we had a MT predictor VS sell at the higher time frame resistance with our MTP trend grey. So can you see how the setup came in at the higher time frame resistance? So shorter time frame setup at the higher time frame resistance. Therefore, it shows that the picture started to become clear. So right mouse click over the red cell bar, do analyze trade setup. This then gives you the trade setup. Remember, we're risking 2% of a sample $20,000 account. That gives you the number of contracts to trade. If you're, say, trading a smaller account, that can be adjusted as well to keep your initial risk small and under control. But if we keep it on the default account, that just keeps us where we are before. The reason we do this is because if the market gets to its target, which you can see it has, and if you look at our main MT Predictor website on the homepage, you can see I did a recording of this particular trade setup back when the market was up at this level here. So before it got to the profit target, in other words, before it actually got to this level here. So you can actually see that we did actually look at this before it actually had totally unfolded. So we're not doing this totally in hindsight. But the idea being is if the market gets to the projected level, which it did here, the profit is large, not just in dollars, but in risk reward units. In other words, here the profit was just over 4 times the initial risk. What that means is when you make a losing trade, and you will, all traders make losing trades, this is what we have to know and accept and understand. The loss is kept small at 1R or 1 risk unit. But we're looking for over time to have profits that are large in relation to those losses. So as you can see, the market came down to the first target. That's where you come out with a profit of 4R. So this was an absolutely lovely example, wasn't it? Where the market reversed right off our higher time frame resistance, gave us a trade setup at that level, went straight down into our target very nicely indeed. Was this isolated? Not really, because if we actually go back to the 60-minute chart and we go back to this pivot low here, right mouse click, place the DP on. Look what the market did in around here. It went through the typical, but this is where we can use the maximum. And when you're a bit more experienced, can you see how it went down to the maximum level, then reverse back up again? So this is where we'll take this one off. We now have a look at see what happened on the time frame we're looking to trade, which is the shorter time frame. So if we go back here, this is what unfolded. Here's our higher time frame support. So this is what we're looking for. We're looking for the markets to make reversals at our higher time frame support and resistance levels. If they don't make reversal at these levels, we deem the picture's unclear, and that's when we look to go to a different market and a different time frame. But if the market is indeed making reversal, a nice reversal like this, we then deem the picture's clear, and we then look for trade setups in the new trend direction. So the previous setup came in right at the level, didn't it? But this one, because the market is making a reversal off a low support level, the new trend direction is deemed to be up. This is confirmed by our MTP trend color, where the market trend went from grey or black to show it's in the process of making a reversal to blue here to show it was up. Therefore, we'll be looking for buy setups. So we'll be avoiding this sell setup here, but we'll be looking to take buy setups. And there was one here. In fact, there was another one back here. Do you see this little history triangle there? So if I right mouse click, do analysis, that would have given you a trade setup, and this would have actually been a losing trade. It's important to look at losses because they will come through. Took you in to a long trade, it then stopped you out. Again, position sizing kept that initial risk at our -1R. So in other words, when you came through here, that would have just been a 1R or one risk unit loss. Comes into this setup. This one was a W3 or wave 3 trade setup. We like these because they're typically at the end of a wave 2. Again, we've covered these in quite a lot of detail in previous webinars. You can go and have a look at the recordings of those. But can you see how this was now in the direction of the new trend? So therefore, this would be a trade setup that you want to take. This would be our profit target. With wave 3s, the profit targets are normally quite large because there's looking to trade the wave 3. If we then move forward, can you see how the market went up? It's now gone sideways for ages. Get that white space off. It's gone sideways for ages, and it's now just hit, or early today, hit that particular level here. Do you see that? That's our profit target there. In fact, that actually was coincidentally at the same level as our high time frame resistance. You'd had added confidence that this was a level to get out of your market. But the point being is it hit the profit target there, where a profit of just over 6.5 times the initial risk was available. But again, this is the beauty of these particular trade setups, is because the profit is large, but not just large in dollars, but large in risk reward units. In other words, we're looking to have profits that are larger than the losses that come through. Mazir, the timeframes you follow is up to you. I mean, you can look to just trade on the shorter time frame 3-minute charts, or you can have keep these in your scanner and just keep an eye on the longer time frame, ones as well. Just that there's been some lovely trade setups here on these 15-minute, and the initial risks are still quite acceptable. They're still quite small. Obviously, if you have a longer time frame, the bar entries can be bigger, and therefore your initial risk can be larger as well. Jan's asked a very good question. Jan, there was it went sideways here for quite a while before reaching the target. I mean, this is what markets do. This is the psychology of trading we touched on last week, in that markets can be awfully frustrating and hard work, and actually trying to keep in a profitable trade before it reaches target psychologically can be awfully difficult, particularly when it's chopping sideways like this. So this is a psychology kind of angle that maybe we'll touch on in a few weeks time, but it's definitely one we've talked about before, and it is psychologically quite hard to do that. But nevertheless, that was the higher time frame resistance. That's where the target was in conjunction with our typical wave 3 WPT target, and it did indeed reach that level before reversing down. So a couple of good examples there, and examples to show you how we use MT Predictor, where we're not looking to trade off every trade setup. We're only looking to trade when the market makes a clear reversal at higher time frame support and resistance. So you can see here, we're looking to on the YM, because if you go and look at, say, the ES on that particular time frame, the ES, there's the high there. And if I go out to the 60-minute chart, did the ES make a reversal at higher time frame resistance? It was it was at the maximum, but it wasn't quite the same as the typical. It wasn't as ideal. If you look at the NQ, did that make a reversal off the? It didn't. It was beyond it. Do you see what I'm getting at? In other words, it was beyond the level. So you're looking to only trade when you get the clear picture. So particularly if you're trading the 3 E-minis, quite often you'll get times where a couple of them won't be very clear, but then suddenly one of them, the reversal comes in absolutely perfectly. In other words, this is what we're looking for. We're looking to only trade or consider trading when the market is making a reversal off projected levels. In other words, when it's doing what you anticipate. You ask the question, what are you doing, Mr. Market? If it comes back and says, yes, I'm doing what you projected, then you deem the picture's clear. For you guys who are eagle-eyed as well, the rally off this low here looks to be a 5-wave sequence. So this is not particularly, for most people, but if we right mouse click here at this high, just give it a second to calculate. Can you see how the rally off here is actually 1, 2, 3, 4, 5 with the high at the minimum wave 5 WPT? So yet another reason why that was a good high coming in. Where does the market typically go to after a completed 5-wave sequence? All of you who've been with us for a while should be shouting at me at the tops of your voices as well, is after a completed 5-wave sequence, the market typically goes to the DP from the previous wave 4. So that is typically it goes to that DP there, not the maximum, but typically it goes from the completed 5-wave sequence to the DP from the previous wave 4. And you see that's exactly what the market did there. So again, that gave you added confidence on your shorter time frame trade. Do you see that? On our VS sell back up here, on this one we're looking at, that gave you added confidence that the market was going to go down to this, in and around this level here. Had an interesting question from Chris. He was saying, how many failed trade setups do you recommend to take before moving on to the next trade setup? Well, this is one thing we were looking at with Mazir last week, is the psychology behind this, and that sometimes all trading system or trading approaches go into losing periods, and it's just the fact of life. It just happens. So you can either decide to stop trading and then wait till you start to get some more profitable trades come through. And there were some tips we looked at in last week's webinar that you can view in the recording. But the main point is keeping the losses small, is that when you have losing trades, you keep that loss small at -1R. So when the profits come through, you're looking to take profits that are here like 4R. And when we did this one here, it was 6.5R, wasn't it? It was 6.8, so 6.5R. So we're looking to have profits that are large in relation to the losses. So the idea being is that one profit can more than make up for 2 or 3, 4 losses. Psychologically, it's quite hard, but for your bank account, that's what you're looking to try to do, to keep the losses small so your trading capital is intact. So then you've got the money there available to take the trades for when the profitable one come through. But as far as how many trade setups before you decide to stop and then review, that's purely up to you. Every single trader is different. Again, there's no hard and fast set rules that I can give you on these kind of things. It's all because every single one of you are individuals and you all have different risk profiles, different tolerances, different experience. So it really is up to you. You just, whatever works for you personally the best. Just want to pull out the trading view add-ons into the chart here as well, because if we look at these, this is on the E-mini here. And if I look at the 15-minute chart, this is our trading view scripts. There's exactly the same setup. So I'll just hide the standard setups, you can see there's the advanced setup, which is a W3 trade setup there. There's your VS sell coming in at the high there. So, our trading view scripts, the same setups as we have on our NinjaTrader charts as well. Same with our standalone version. If I pull that up, here's our standalone version. There you go. There's your VS sell coming in exactly the same there as well. So whether you're using our standalone version, the trading view charts, or the NinjaTrader add-ons, they will be the same trade setups come through. So that's the basic of what we're looking to do with MT Predictor. We're not looking to trade 100% of the time. We're looking to go to the higher time frame chart. We're then looking to place our DPs on the higher time frame chart. We're then looking to see whether the market makes a reversal off the projected DP levels. If it does, we then deem that the picture's clear. If the picture becomes clear, we then look on the shorter time frame for trade setups either at the projected reversal level, as in this YM example, or after the projected supported level. Remember that was the support level there, wasn't it? After the level, confirming that with our MTP trend, then looking to trade in that direction of that new trend. If the market doesn't make a reversal at the projected level, we deem that the market pattern is unclear, and therefore we look to wait for another market, another time frame, or we just wait till that particular market and time frame starts to become clear. In other words, we're only looking to trade when the picture's clear. That is the basis of what we're looking to try and do with MT Predictor. So it's nice that we've got a lovely example here where this is absolutely perfect here. There's the higher time frame reversal. There's the shorter time frame resistance. Here's your trade setup down to the first target for a nice profit that's large in relation to the initial risk. So this encapsulates exactly what we're looking to try and do with MT Predictor. So are there any questions that people would like to ask in the last couple of minutes? So Chris says that ES has an inside gap today. Yeah, this data I've got here is actually delayed data. I'm using IQ feed on delayed data into the NinjaTrader 8 add-ons. So Chris has said that it's the ES is an inside gap today. So of course this wouldn't be applicable. Our gap play that we're looking at here wouldn't be applicable today because it's an inside gap. So hopefully you've enjoyed looking at the gap play as well. It's something I haven't talked about for quite a while. Again, I don't tend to talk about it a lot because it's not particularly MT Predictor specific trade setups. It's purely and simply looking at whether the market using the day session only, this is only applicable to the E-minis, opens within or outside the previous day's range, and then looking to see whether it has got to the average range over the last 20 days. And then you can simply look to try and do a trade setup in and around the break of the first 3-minute bar, as long as a risk reward of potentially 2R or twice the initial risk is less than that level of the average true range. And we're looking for the market to go through that straight away. Again, we're not looking for this. If this happens and it doesn't break the projected buy level, the buy trigger here, but goes through what would be the stop trigger first, as it did here, then that's not the kind of market we're looking to trade because it doesn't show strength off the bat. What we're looking to do is use the outside gap to indicate potential strength and a market to then follow through in particularly the first part of the trading day, like you did here, is just follow through there. That's what we're looking for, a move off the open like that. And that's what an outside gap up and typically represent or indicate. So any more questions in the last couple of minutes or the last minute or so? Or are you all happy with what I've been looking at for today? Good, I think you're all fairly happy. And so here we go. You can see this is what the market is doing on the YM at the moment. Well, actually, this was 10 minutes ago because the market is open 10 minutes ago. This is delayed data again. If you want to see what the market's doing live, here we are on my trading view charts, which has got live data. So this is what the market's doing at the moment. Right, I think the questions have sort of dried up now. So thank you very much, everyone, for coming into to today's webinar. Hopefully you enjoyed today's webinar, particularly reviewing our MT Predictor standard trade setups. Again, that applies to all markets, all timeframes. I didn't really look at Forex, but we do exactly the same things. Here's an example on Forex I was looking at on the Euro JPY, where on a 4-hourly chart, if I go out to the daily, there's the support from the previous pivot there. You see, there's the DP daily support. So on a shorter time frame, the 4-hourly one, there's a VS buy. That gives you exactly the same particular setup on a Forex chart. Again, using a 4-hourly for the trade setup with a daily for the higher time frame support and resistance. So exactly the same if you're using different markets and different time frame combinations. Next week is Labor Day holiday in the US, isn't it? So we won't be having a webinar next Tuesday. We don't do that because normally the markets are quite quiet because of the Labor Day holiday. So for you guys in the US, time to have a little bit of a holiday on that, and I'll be joining you even though I'm in the UK. So there'll be no training webinar next week. So the next training webinar will be in 2 weeks' time. So I hope you all have a good couple of weeks trading. And if there are any questions, drop me an email, steve@mtpredictor.com, and we'll try and include them in next week's webinar. But hopefully today's webinar has been a good, not only review of our standard MT Predictor trade setups, but looking at the ATR range, which is something slightly different, and a few other topics as well. So hopefully it's been a good webinar. You've all enjoyed it. So have a good trading week, and we'll be back to do it all again in 2 weeks' time. So have some good trading till then.